Hello and welcome to Virtual Investor Conferences. My name is Anthony Kraus, and on behalf of OTC Markets, we're very pleased you have joined us for our next live presentation from Ecora Resources. Please note, you can submit questions for the presenter in the box to the left of the slides. You can also view a company's availability for one-on-one meetings through the Schedule Meetings tab found on the conference platform. At this point, I am very pleased to welcome Mark Bishop-LaFlèche, Chief Executive Officer of Ecora Resources, which trades on the OTCQX Best Market under the symbol ECRAF and on the LSE under the symbol ECOR. Welcome back, Mark.
Hi all, and thanks for joining us today for our presentation. So jumping right into it, what is Ecora's vision? And it's very simple. Our vision for this company and for this platform is to create a platform and a portfolio of royalties that provides investors with de-risked exposure via the royalty model to the energy transition thematic. And so the next logical question some of you may have is, well, what is a royalty? And in short, a royalty is an instrument whereby Ecora, by virtue of making a payment to a mining company, for example, requires the right to receive a portion of the revenue generated from the extraction of minerals sold from that property in time. So simplistically, let's take you through an example. Ecora requires royalty, 1% over an operation. That operation extracts 1 unit of mineral resources. That unit sells for 100. We would receive 1% of 100. And the royalty model provides a number of benefits that are somewhat different in their nuances to investing directly into a mining company. The royalty model is driven primarily off of production in a period within our royalty area, the commodity price that's realized on the sale of those minerals. And by multiplying our royalty rate, that is effectively our royalty line. Obviously, on the right of this slide, you can see it's somewhat different for a mining company. We don't have direct exposure to the operating costs of extracting those minerals, nor do we have direct exposure to the capital costs of extracting the minerals. Therefore, by definition, the royalty instrument, by virtue of not offering the operating leverage or the capital cost leverage to an underlying operation, typically is lower volatility in terms of its revenue profile, and thus relatively offers a relative de-risk way to get exposure to the commodity basket without the direct exposure on the positive and negative side in terms of the risks of operating a mine. And of course, as the royalty model, since our revenue is derived from our royalty income, is derived from an underlying operations revenue, the business model over time benefits from inflationary trends. And to give you a simple example, 20 years ago, the price of copper was around $1 per pound. Today, it's slightly over 4. Therefore, if you had a royalty 20 years ago, 1%, you get 1 penny for every unit sold. Today, you'd have 4 cents without any of that operating cost drag and without the capital costs associated with producing those units. So just an example to show over time that the royalty model is really well positioned to provide that commodity price exposure without some of the volatility that exists by going into the mining sector, which can be desirable, or it can be something that investors prefer to avoid, depending on how they're looking to construct their exposure to the sector. Here's a quick snapshot of our business. Our business is primarily located almost 100% in OECD jurisdictions, which is something that we've done deliberately. Our commodity exposure as of today is 3/4 base metals, of which the majority is copper. That's as a percentage of our net asset value and not yet our revenue. And we've really sought to acquire royalties over assets that are relatively low cost operations relative to other operations producing the same commodity. And that the reason for that is a simple one. In the royalty and streaming sector, the key is to have exposure to assets that are well positioned to generate strong cash flows throughout commodity price cycles. And as I mentioned in the royalty model, one does not have direct exposure to operating costs, but should an operation no longer be profitable, the operation is likely to shut down. And therefore, we've sought to position our portfolio very defensively by acquiring exposure to leading mines that are already in production or mines that are expected to come into production at very low operating costs relative to other global operations. Our portfolio itself is weighed primarily roughly 50-50, but roughly 50% to producing royalties, and the next largest allocation is to royalties that are very close to first production and advance on the development curve. And of course, we have a small aspect of our portfolio, a tail of earlier stage assets that offers really exciting value opportunity through time as these assets are brought up the development curve. A quick snapshot of our asset base. I think what's really interesting about this slide, Ecora ultimately, while we ourselves are a relatively small cap business, the folks operating the mines themselves are not. And it's a very different sort of risk profile that Ecora offers relative to investing in a mine or a miner or a developer with a market capitalization of equal size. Here's our growth pipeline. I think you can see here it's very heavily weighed towards assets, again, in OECD jurisdictions, but primarily actually to nickel and copper. Copper primarily, actually. And for any of you who have been tracking Ecora over the years, we like to include this slide just as a directional update on where the business is going, but also where it's come from. And if you went back to look at this company in 2015, what you'd see is that the majority of the asset value is in one single royalty called the Kestrel royalty, and that was primarily in metallurgical coal. Today, our net asset value has changed significantly, and we invested a fairly sizable amount of capital to reposition this business such that it has exposure to assets that are expected to produce well into the future, whereas the Kestrel royalty, as we all know, will be approaching the end of its life materially in 2026. And to that, and this is what our portfolio looks like in the future. You can see the solid blue line being our basket of future-facing commodities, excluding the met coal, which is the light blue line. And then as we look to the medium term, we have substantial growth. And actually, I think what's really interesting about this business is that 2025 probably marks the first year where we hit a real inflection point as to this business growth profile. First, in terms of really near-term things in 26, but fairly consistently all the way through for the next 5 years, our portfolio delivers substantial organic growth potential. And that's, of course, before we take into consideration any additional royalties that we may acquire in the future. And as I mentioned just now, the first and most immediate catalyst for this business is our exposure to the Voisey's Bay mine, which, as you can see on the left-hand side of this page, a very steep ramp up in the production of material from the underground operations. And that's primarily on the basis that the underground expansion project at the Voisey's Bay mine is now very close to achieving material completion. And we should see from 2023 to 2026 by the end of the year, when the mine is expected to be running close to full throughput levels, almost a 400% increase on the units delivered to us under that investment from 2023 to 2026. So it's a really sizable portion of our growth, and it's immediate. We've already beginning to see the benefits of that ramp up. In the first half of this year under the stream, we received 4 deliveries of cobalt. Over the Q3, we anticipate to receive 4 with 2 on the water already. So the asset is really starting to ramp up, and that's something we think that the market will view very favorably. And then beyond that, one aspect of our business, which it really isn't sort of discussed that often, and in our opinion, it's often overlooked, is that Ecora offers a copper growth pipeline that runs well into the next decade with strong counterparties, strong assets, low on the cost curve. In time, this business will see a catch up between today, what is the majority of our net asset value being copper, to translate to the majority of our revenue profile being copper. And of course, the supply-demand dynamics for copper are, in our opinion, highly compelling. So what's priced into the shares today? It's a challenging time for companies of our size, but also the companies of our size in the natural resources sector. But that certainly creates an opportunity for investors. As of today, price in today's share price roughly is the value of our producing asset portfolio, with all the gross effectively for free. So it is in that sense a very interesting opportunity that provides substantial capital gains appreciation potential. But it's also underpinned by current dividend yield in the range of 4 to 5%. So how do we think about taking this business forward? Well, we think there are a number of ways that we can further grow this business while also unlocking the value in our share price that's not yet reflected in the development portfolio. And the first thing we think we can do to achieve this is to further infill our revenue profile around some of the big acquisitions we've made, and in other words, by acquire royalties which will further diversify our income profile around the cornerstone assets that we've recently acquired. And furthermore, really focus acquiring royalties or streams that are likely or are producing or have a great line of sight on near-term royalty income. That being said, we're loath to neglect some of the smaller investments in slightly earlier stage opportunities, which may, in these capital market conditions, be available. In a better capital markets, they might not be. So we don't ignore those opportunities, but the majority of our time at the moment is to focus on assets, as I mentioned, that are closer to production. And then from a commodity basket, well, as we gave you a quick feel for our commodity complexion at the beginning of this presentation. But in other words, at Ecora, we're effectively targeting minerals that are crucial for, number one, producing low carbon or renewable power. Number two, the transmission of that power. And then number three, the storage and consumption of electricity. So within that framework of electricity supply chain, effectively what we mean by our commodity basket is basically everything other than precious metals and hydrocarbons. So it's a very wide base of industrial minerals or industrial commodities, but we're still very keen to keep base metals and beyond that copper at the core of our commodity exposure. So looking ahead, this is a somewhat busy slide, but it gives you a feel for what I mentioned earlier, in that for this company, we're really approaching what appears to be an inflection point in terms of our short-term growth and medium-term growth. I won't take you through every detail here, but if you have any questions, be happy to pick some of those up at during the Q&A session. So here to summarize, if you were to take 6 things away from today's presentation, I think the first thing is that our producing portfolio, in other words, the assets over which we have royalties, the mining operations that are in production today, are expected to grow the production profile from 23 to 2024, and then again in 2024 to 2025, which is a great backdrop for volume growth and potentially earnings growth subject to commodity prices. Number two, Ecora offers a very strong copper growth portfolio. In fact, that could be, if not the leading sector-leading collection of royalties to this copper commodity. We've built a portfolio with exposure to world-class operators. As I mentioned, Ecora is a small-cap stock, but the folks operating the operations for the most part are not. The business has a very strong balance sheet, low leverage. We have no firm capital commitments. Absent transactions, we'd anticipate our balance sheet to deleverage fairly quickly over the next 12 to 24 months. And the equity today for investors is, of course, an attractive entry point, or appears to offer the ability to acquire shares at it's roughly 60% discount to estimated net asset value as calculated by research analysts. And last but certainly not least, some of the same factors that have created a bit of downward pressure on the Ecora share price as a result of sector-wide trends have created, on the flip side, an uptick in opportunities for Ecora as a permanent vehicle financing the mining sector. And so whether or not this will translate immediately into royalty acquisitions, we shall see, in that some of our royalty acquisitions take months, others take years. But in any event, when we think about the opportunity set that's available to us in 2024, we've definitely seen a strong uptick versus the prior years, especially in the commodities that we're really targeting. So with that, thank you very much, and I'm more than happy to turn to Q&A. So the first question here is, could you discuss your dividend policy and how you return capital to shareholders? So we updated our capital allocation framework earlier this year. Our capital allocation framework has 4 priorities, the first being growth, the second being deleveraging, the third being capital returns in the form of dividends, and the fourth being potential to conduct buyback programs at times when the equity may be trading substantially below the estimated net asset value. So focusing on the first part of your question here, which is the dividend policy. The business has a policy of distributing between 25 to 35% of the average free cash flow generated in the prior 2 half-year periods. So for example, at the end of June 30, 2024, we calculated free cash flow for the first half of this year, free cash flow for the second half of last year, took the average and paid out just under 35% of that free cash flow to shareholders. The next question is, how close to production does a mining company need to be for consideration? Historically, we've really looked at a range of opportunities here. We've looked at things that are, of course, in production all the way down to pre-feasibility study stage. And we've always managed the development risk by allocating specific amounts of capital to the different opportunities depending on their development. So the largest acquisitions we've ever made are those which were in production, things that are permitted, FID'd, a final investment decision for construction, or very close, or the sort of second largest bucket of capital. And then for the smaller, we've allocated smaller amounts to longer dated royalties. In the past, that's been around less than 5 million. It's important to keep in mind that by managing our capital outlays to acquire royalties by size, we can then achieve and optimize overall portfolio complexion such that our business primarily remains weighted towards assets that are in production or those that are very close to production, with a small amount of exposure being really high quality projects that may come into the production into the future. But by virtue of their quality, we're able to take a view and allocate a much higher probability that these projects will come into production as a result of their cost competitiveness, for example, as well as jurisdiction and ability to bring the project through the development curve. The next question is, Ecora conducted a buyback program earlier this year. That didn't really help the stock. Will Ecora consider either a new one or another ongoing program? The program itself, the logic to the buyback program in itself was not necessarily to help the stock in terms of the stock performance. It would have been great if the stock had traded up, but the goal of the buyback program was to allocate capital to acquire really high quality royalties at a substantial discount to value that we see in private transactions. In this instance, it was buying exposure to our own royalty portfolio. In that sense, the program was very successful. It's very difficult to see in the market royalties of this quality at that entry point. In terms of the future, as I mentioned, buyback programs are a priority within the context of our capital allocation framework, which are regularly considered by Ecora's board of directors. At this stage, in the short term, from a capital allocation perspective, we're likely to allocate capital towards acquiring royalties and deleveraging, having just completed a buyback program a few months ago. That's not to say, though, in the future that the board wouldn't reconsider or would not consider, proceeding with a buyback program should the equity be trading at a substantial difference or a discount to the estimated net asset value. But ultimately, to just finish that answer, from where we sit today, we think that by acquiring royalties that are close to production or in production, and by further diversifying our near-term royalty income profile, we can unlock a lot more value in terms of re-rating of the Ecora equity. And thus, we're also keen to keep our powder dry should those opportunities become available. The next question is, how are you impacted by valuations of your underlying portfolio companies? That's actually a pretty interesting question. Usually in the market, what you see is that royalty companies typically trade typically trade at a valuation premium to mining companies, not necessarily because royalties are better or worse, but because often royalty companies can have less volatility in their earnings. Ecora, by virtue of our Kestrel royalty, sees a bit more movement than most royalty companies in that sense. That being said, with the Kestrel royalty being so short-dated, as we look ahead 24 months, the business's revenue line should see substantial reduction in volatility that in part historically has been driven a lot by the Kestrel royalty. In terms of actually sort of looking at the underlying businesses themselves, there's definitely a read across in terms of how our company is valued in the sense that if a mining project is subject to really positive news or is has a big development project or is increasing production, there's clearly a read across for Ecora if we have a royalty on that property. But I can't say Ecora trades a bit of a blend of its entire royalty portfolio and also the commodity prices themselves that underpin the royalty portfolio, rather than as a direct correlation to the underlying miners or the project developers. Next question is, what is the status of Ecora's lending relationships? Is capital available for future royalty acquisitions? Ecora has a revolving credit facility with 3 of the leading financiers to the royalty sector in terms of lending banks, being RBC, Scotia, and CIBC. The facility has a availability of 150 million. We currently have net debt in the range of 85 million. And the facility also includes an accordion feature to fund further growth, subject to the transaction, of course. We could take the facility up to $225 million. So that's certainly not infinite capital. On the flip side, Ecora is still a relatively small business, and it should be sufficient capital to substantially move the needle for Ecora for where we are today. That facility has grown over the years as well as we've grown our royalty portfolio. 10 years ago, that facility was either 0 or around 10 million, which then grew to 30, 60, 90, 150, and so forth. So the business's ability to support borrowing has grown with the business, and we'd anticipate, should we continue to grow the business in time, so would our borrowing capacity. So the next question is, can you give an update on the rare earths royalty recently acquired in South Africa? This is a really exciting transaction for us, I have to say. We've spent the better part of 6 years looking at the rare earth space, and this project over which we acquired a royalty, project being the Palabora project owned by Rainbow Rare Earths, just consistently screens at the top of the list as being one of the best undeveloped rare earths projects in the world. Part of that is because the project itself is not actually a mine. The operation contemplates treating residue material from the production of phosphoric acid that's used in fertilizers. So today you have stacks of gypsum material which contain the rare earths, but they're in neat rows and they've already been crushed. So there's no mining per se, there's no crushing, there's no trucking. For from a cost perspective, as you can imagine, this operation compares very favorably to many of the other operations in the world. And furthermore, the operation itself is backed by a really strong team. So we're really delighted to have acquired that royalty earlier this year, especially given that the operation produces two rare earth elements and DPR as a majority of its basket mix. And those are the rare earth elements that are projected to see the most demand growth over the next coming decades, both in the short, medium, and long term, given the NdPr rare earth elements are absolutely crucial for the production of permanent magnets for use in wind energy turbines, like renewable energy turbines, but also in electric motors. The next question is, could you describe the pricing situation within the royalty industry? Is new capital coming into the industry driving royalty pricing down, or is capital becoming more scarce, meaning that higher royalty percentages are available for the remaining capital? I think that's a really interesting question. And part of that is a function, I think, of where interest rates have moved. So if you look at the sector 4 or 5 years ago, with interest rates being as low as they were, there was a lot more capital available for royalties that were over relatively longer dated development projects. Where we sit today, there is less capital available for those opportunities, just generally speaking, given the opportunity costs and the higher risk-free rates that could be theoretically earned by investing in, say, a fixed income security. And number two, it also means that for businesses that don't have, although we're still very small and we have, compared to some of the largest precious metal businesses, in that context, fairly small borrowing capacity, compared to royalty companies of our market cap, our borrowing capacity is very high. And thus we're not entirely reliant on issuing equity to acquire royalties, which is strategically a really big advantage. If Ecora were entirely reliant on issuing equity to fund royalty acquisitions, what that means is at times of market pressure and when market conditions are challenging, you effectively can be locked out of growing the business. And actually that's precisely the time in any cyclical business when one really should be looking to grow royalty exposure. Trying to pick the next question. So one question here is, how do you source new royalty streams? That's a long answer, but the short version is we do just about everything in the first instance to identify within our targeted commodity basket which projects we think would be really good fits. In other words, which projects would we love to have royalties over? And that, of course, is a function of jurisdiction, counterparty, commodity, management teams, but of course, whether or not those groups are likely to require our source of financing also comes into consideration. And these sort of conceptual lists are regularly reviewed and updated. And then we have engaged relationships and develop relationships with these management teams. That can take years or it can go quickly. But that's probably another of our competitive advantages in that we've been, as Ecora, in this business for, myself personally, well over a decade, but within the company, probably 6 to 7 decades of experience, so 60 to 70 years of collective experience, structuring, negotiating, and completing royalty and streaming acquisitions. What skills does Ecora have to evaluate all these projects? Yeah, that's a good question because it's a lot of projects, but it's also a lot of different commodities. So in-house, we have, as you can imagine, a strong level of legal, financial, and commercial, as well as technical expertise. And our strategy has been historically to have an element of technical support of really high caliber internally, but on a deal-by-deal basis, work with external consultants who are respected experts in that specific commodity or project. And so to say that in other words, to try to hire in-house at Ecora expertise in 10 different commodities with expertise in underground, above ground mining operations, metallurgical flow sheets, it would just be an enormous fixed cost for this business. And therefore, what we've sought to do, and I think it's a great way to run this business personally, as it keeps our operating costs down, is to have a level of internal support, and then on a project case-by-case basis, identify experts, really that's amongst the best experts in the world for those types of opportunities, and get support from external consultants as necessary. And I think that's all the questions that I see here today. So thank you very much for your interest in Ecora.